Okay. All right. We're gonna get rolling here. So, welcome everybody for coming out. We appreciate you taking the time, spends a couple hours with us here as we go through the wonderful world of buying a home and obtaining a mortgage. My name is David Friedman. I am the retail lending officer here at Ulster Savings Bank. I've been here about 9.5 years. Been in the business over 30 years. I have been a loan officer. I've run processing teams, underwriting teams, sales teams. I've done pretty much everything you can do in the business other than be the receptionist. In that time, I have learned an awful lot of things, and I've done a ton of training with people. We do these homebuyer seminars about every other month, and we've been doing that for, I think, 8 years now. So we have done this for hundreds and hundreds of clients, spreading the wealth of our information and knowledge and hoping to get you better prepared for the journey that is this home buying process. We're going to be joined by a couple of guests here tonight. But before we do, I just want to run through a couple of housekeeping ground rules type of thing. One, I would ask you, I'm looking at some of the names that are logged in here. I would ask you if you have some kind of a generic name, like I see an iPad, sometimes I see phone numbers or, Google Pixel, whatever. I would ask you to go ahead and change it to your name. See, one of the ways that we can keep track of who was on the call after everything is said and done. So if you could do that for us, that'd be great. In terms of how to do it, different systems will have different ways to do it, but somewhere on your screen, you should see some dots for like more or additional information. And usually if you go in there, you can rename yourself. So I just ask you to put in at least your first name and last name, or at least your last name. This way we can just identify who was on the call afterwards. In addition to that, I'm going to go ahead and change screens here. So this is an involved process, the home buying process. There is a ton of information we're going to throw out at you here tonight. There will be some things that I'll tell you should go ahead and either write down or take screenshots of. Don't try to jot down notes all along. There's too much stuff that we're going over. Most people can't adequately write and listen at the same time. So there will be some things that we'll point out to you along the way. Hey, make sure you make note of this, write this down, what have you. Otherwise, best bet is just to go ahead and try to pay attention as much as you can as we go through the information. We are going to be together for a couple hours. I realize that seems like an excruciating long time, but there is just an awful lot of information that we want to make sure that you guys have to, like I said, to make you as best prepared for this home buying process as can be. The other thing is we will be stopping about 4 or 5 times along the way to do some questions and answers. What we ask you to do is to utilize the chat box. You should see that as an option on your screen somewhere. Again, whether you're on a phone or a Mac or a PC, it'll be in different spots, but you should see a spot for a chat room. Go ahead and use that and send the question to all. Okay, don't just send it to me directly. I have one of my partners on the call with me, Sean Dykehouse. He's going to be helping to manage the Q&A with us tonight. So if you just send it to all, we'll get the question out there. And one of the things I like to say, you see it on the screen here, is that trust me, if you have a question, chances are somebody else on the call has the same question. So don't be bashful when it comes to this. It's the only way I know for sure that you're paying attention is if you ask some questions. It's one of the things that I lost when during COVID we switched from all in person to mostly online calls, and we've kept that because we're able to cover a much bigger geographic area. Obviously, if I'm doing this in person in Newburgh, it's going to be tough for people from northern Dutchess County or Ulster County to come down and join us. So we do most of these online like this because we're able to cover a lot more people in the same amount of time. So like I said, don't be bashful about asking questions. We'll be stopping 4 or 5 times through the presentation. And then if we have time at the end and my voice holds up, we'll stay on at the end to answer any additional questions. Okay. And the other thing is you may hear me pause periodically. as I let you all into the Zoom room, that is a manual process. So sometimes I have to just stop for a second and click on to let people in. Don't be thrown off. Doesn't mean my screen froze or anything like that. Just sometimes I have to pause to do that. All right. With that being said, let's go ahead and kick off. And I just need to switch screens here real quick. And I'm going to bring on tonight's special guest. Eventually. Okay, I think this is working. I'd like to introduce our special guest for the evening. This is Eileen Clifford. She is the Director of Housing Programs at an agency called Pathstone. Pathstone is one of the many, or the handful, I should say, of not-for-profit agencies in our area that we work hand in hand with to help you get into your dream home. Eileen, welcome to our presentation tonight, and go ahead and take it away.
Sure. Thank you so much, David, and thanks to Ulster Saving for doing this great event. And it's so good to see so many people have signed up for this. Um, Again, my name is Eileen, as David stated. I work for Pathstone Housing Program. My office is located in Newburgh at 1 Corwin Court. And I've been with the agency 33 years. I've been doing home ownership for 28 years, and I'm grateful and thankful to say that Ulster Savings has been part of that journey. When we first started our program down in the Mid-Hudson region, Ulster Savings was one of the first lending institutions to agree to be one of our partner lenders. So we truly appreciate that relationship. You can go to the next screen, David.
You think so?
Oh,
Okay,
while
there we
he's
go.
while he's doing that, I kind of know word for word what I'm going to say, so I could have started. But just to tell you a little bit about who Pathstone is, we're a nonprofit organization that started back in 1969 up in Rochester, New York, and now we are in 9 states and Puerto Rico. So we have over 600 full-time employees and probably about 200 part-time employees. Uh, we started out as a farm worker advocacy program, and we've evolved into a very large human resource agency. So we have a lot of programs. I think there's like 28 different lines of business that we operate in these different states and in Puerto Rico. So feel free to visit us at our website at www.pathstone.org. Next slide, please. So our office is located in Newburgh, but we cover Orange, Ulster, Dutchess, and Sullivan counties. And what we do is we provide education and counseling to groups and individuals. It's myself, and I have a full-time housing counselor, Maggie Guzman. So when we meet with you, we talk about things like budgeting, credit, fair housing, the home buying process, a lot of what you're going to talk about tonight, but we do it in a classroom setting, either in person or virtual. And then we talk about some potential grant programs that you may be eligible for. Most of them are income and family size. So we're not going to get too much into that, but if you want to reach out to us, we can have a private conversation. We do have partnerships with many lending institutions, including Ulster Savings, but we also work with different organizations and municipalities. So, for example, we work with Habitat in Newburgh, we work with the Newburgh Community Land Bank, the City of Middletown, and then other local lenders. And we need to be kept up to date by them what some of the down payment and closing cost assistance programs are, because some of them come and go, meaning that they're available for a period of time. Once the funds get exhausted, then we have to wait for a new round of funding. So if you can go to the next slide. So to get started, you can contact our office and David or Sean will share in the chat if you're not taking a screenshot. You can contact our office in Newburgh or you can email us, so they'll share that information with you. You can request an intake packet. You'll complete and return the packet along with supporting documentation. So David's going to be going over this. What are you going to need? Pay stubs, bank statements, tax returns, those are all things you want to start thinking about collecting. Once you submit your documentation, we review it. We pull a soft pull credit report. We give you a copy of it, and it gives you your mortgage credit score. So unlike going through Credit Karma or any of those aren't bad, but those aren't really the scores we're looking for. Either Maggie or myself will contact you to schedule an appointment. When we meet with you, we're going to discuss your income, credit, savings, affordability, and a plan of action. So these are all things as HUD certified housing counselors that we must do in order to assist you. So next slide, please. For our program, you must be a first-time home buyer. So a first-time home buyer is somebody who has not owned a home in the past 3 years. You have to be mortgage and credit worthy. What does that mean? That you would be able to get a mortgage from a lender like Ulster Savings. So they would give you a pre-approval letter. And credit worthy, that just means that your credit meets the criteria that the lenders are looking for. So David again is going to talk about that tonight, but making your payments on time, not being over credit burdened, so owing too much. Again, scores. We don't always like to talk about scores, but lenders do look at it. But again, if there's mistakes, if there's something you need to work on to get your scores up, that's what we're here to help you with. We also want you to receive an affordable mortgage product. And what does that mean? That is within your means, your personal means, not your friends or neighbors or family members, like what your affordability is based upon your debt and where you want to purchase. And of course, taxes are a big deal as well. You can afford the house, but sometimes the tax prices are very costly. We want you to have some money out of your own pocket. So we say we want you at least to have 1,500. But let's say you go to the bank and they say to you, well, you need 2,000. Well, you got to go by their rule, not ours. This is just something that we created. We want you to at least have some what we call skin in the game. And again, these are things that you're going to need to have anyway. You're going to need to have some down payment. You're going to need to have some closing cost money. You have to pay for inspections. You have to pay for your attorney. So again, David's going to go over those things, but just to let you know that you will need some money out of your own pocket, and it all depends on the situation and the circumstances. You can get gifts and grants and things like that. And then the next step would be for you to complete homebuyer education. So we have classes that are in person and online. So you have a couple of options. We also have a company that we work with called eHome America, and they're a great company, and you can join into a class. You can log in at any time, log out at any time, but it's what most people do now, kind of like David said with we used to do these presentations in person, and then we started doing them online. And now people seem to like the online homebuyer ed course, because again, it's when you want it at your leisure, you can log in and log out. So that is the program eligibility for us. And again, I appreciate you all being here, and I'm glad to see so many people still want to buy a home. We are glad to see that, and we're here to help you every step of the way. So again, thank you, David, and Everybody have a great rest of your session, and I hope you learn a lot of good things.
Thank you very much, Eileen. Appreciate you jumping on with us here tonight. And can you just go again? What geographically, what areas do you cover?
Sure, we cover Orange County, Ulster County, County, and Sullivan County.
Okay, great. Great.
Okay?
So probably overwhelming majority of the people on this call will
Yes.
fall under that.
And
So
if
so
they're
that should be
right,
good.
and if they're in a different county, I know you know other agencies that can help them as well. Yeah,
Hmm.
up further up in other Putnam and maybe up towards Albany.
In
There's
Westchester and
yep,
yep,
there
we got
Rockland.
them
Yep,
north and south. Okay.
exactly. So thank you
All
again. I
right, great.
appreciate it.
Thanks a lot. If
You're
anybody
welcome.
has any questions directly for Eileen, you can put it in the chat room, and we will get those questions over to her, whether it's now or tomorrow. We'll get those over to her. Make sure that you guys hook up.
Sure,
Okay?
and we will respond promptly. Okay.
Of course. Of course.
Awesome.
All right. Thanks,
Great.
Eileen.
Thanks so much. Bye bye.
All right. So I'm going to do this. Bear with me here, switching back to my original program here. Okay, that was pretty painless. All right, so that was Eileen Clifford from Pathstone, and they do have a lot of good programs and tools that are available to you, especially for first-time home buyers that maybe you're not sure if you're in the right position to be able to buy a home right now, but you're hoping to be able to be maybe in 6 months or a year. They have a lot of good tools that can help you to get to that position a little quicker with a little more confidence. Okay. So just going to talk a little bit more about, hopefully, Ulster Savings. Okay. So Ulster Savings, we just celebrated our 175th anniversary. We have been around for 175 years, a tremendous accomplishment as a community bank. We serve our local communities. We have 15 branch locations throughout Dutchess, Orange, and Ulster counties. We have 2 lending offices. Our headquarters is here at where I am, is at Schwenk Drive in Kingston. And we also have a lending office in Goshen in Orange County. Okay. Our operations centers, our headquarters, like I said, is here in Kingston. And we are what's called a full service community bank. That means a couple of things. One, as a community bank, it means that we are responsible to our clients and our community. We do not have shareholders. Okay. So we strive very hard to make a positive impact in the communities that we're in. And we'll go over a little bit more about that in a moment. But we are responsible to our account holders and the community around us. So we do a lot of philanthropic activities to make sure that we are taking care of those that help take care of us. Our slogan is where every client feels like their family so that they come back with theirs. And we try to live up to that every day. Okay. Moving on. So here's just some examples of the types of things that we do here. You see, this is since the end of 2025. So obviously, we're almost halfway through with 2026. So these numbers have all grown since then. Almost $47 million in affordable housing and first-time home buyer loans in that time. I'm not going to sit here and read every slide to you, but you can see how much time and effort we put in to try to take care of the communities that we're in. So from a lending standpoint, well, as much as we have offices in Dutchess, Orange, and Ulster counties, basically we can lend anywhere in New York State. So if you are looking to buy something upstate down in Westchester or whatnot, even Long Island, we can take care of that. We actually used to have a branch in Long Island, so we did quite a bit of business down there. The only place that we do not lend in New York State, we do not lend in the 5 boroughs. Okay, so unfortunately, if you're looking to buy within the New York City and greater New York City area, that is not something that we can do. They have some different laws down there. They have some different taxes down there that we just don't want to be involved in. But as I said, we can take care of everything from Rockland County and Long Island all the way up to the Canadian border, other than the 5 boroughs. Okay. So we have some, I'd like to call them sister companies, but they're not separate companies. They're all part of the Ulster Savings umbrella. It's not a separate business. But we do multiple other things here, including we have a tax service department where we can prepare your taxes, whether you're self-employed or just want to have your regular household taxes done. We have financial advisors and financial planners here on staff that will specialize in that. We have a payroll department. We have a commercial lending department. We'll talk just a little bit about that as we move along. And our spotlight for this month is on our insurance department. So we have a full service insurance department. They can take care of all of your insurance needs, from auto insurance and life and disability, all that fun stuff. And of course, homeowners insurance, which everybody will need that's on this call. You all need that at some point. So it is a requirement in order to get a mortgage. You do have to have insurance in place, whether that's regular homeowners insurance and or flood insurance if you happen to be looking in a flood zone. So you can reach out to us. You see the phone number at the bottom there. Rose is one of our specialists in the insurance department. Anybody there can help you, but that's her specific extension. If you can't get a hold of her, you can call the general number and they'll put you through to somebody that is available. And we do, it's not a requirement if you're doing a mortgage with us, but we certainly encourage you to take a look at the other products that we offer. We're generally very competitive on rates and, of course, the service. Okay. All right. So let's get to the main event. The whole reason that we're here is talking about mortgage lending and home buying. So there's four main topics that we're going to talk about tonight. You see on the screen, capital, that's the funds that are going to be used to buy the house. That's a combination between the loan that you're going to take out, plus your own money, plus maybe gifts and grants. We're going to get into all kinds of details on that. Capacity, that's your ability to actually pay for the house once the loan is closed. Okay, very important. Credit, of course, that's a big topic. We're going to talk about a lot of different angles when it comes to credits and credit reports and credit scores. And then collateral, well, that's the house that you're looking to buy, or the home, I should say. Maybe a house, maybe a condo or a townhouse. But that is the other big topic that we're going to talk about today. So let's get into the first one, and just bear with me for one moment. I want to try to set something up here. Make this a little bit easier for me. For some reason, I'm not seeing my other screen. Okay, we're going to go with what we got. Okay, so the first thing, capital. That's how you're going to, that's the money that's going to be used to actually buy the home. So a big chunk of that generally is your mortgage that we're going to take out with. And then there's the portion that's going to come from, I'd say, from your side of the table. So this includes money for down payment, closing costs, setting up an escrow account, and reserves. Now, how much of each of these things do you need? It depends. Some of you may have seen me smile a little bit with one of the things that Eileen was speaking about. She used the word it depends when talking about what you may qualify for. It's one of my favorite answers. My staff hates it because I use it all the time. But there is so much of this process and this business that is dependent on the individual circumstances. Okay. And you're going to hear me use that term depends an awful lot tonight. You're also going to hear me talk about individual qualifications, specialized quotes, things like that, because the things that are good for you may not be the same things that were good for your parents or your uncle, your brother, your neighbor, your coworker. Okay. Everybody is in a slightly different circumstances, sometimes a wildly different circumstance. So we want to do everything tailored to you and what you have going on and what you're looking to build towards. Okay. So when it comes to down payment, how much of a down payment do you need? It depends. We have programs where you can put as much as you want down. We generally start thinking about this in terms of the maximum financing that you can do, or minimum down payment. Some people are in a position to put 10% down, 20% down, 50% down. That's fantastic. Other people aren't in that boat or choose not to do that. So we have programs that we can do as little as 5% down. We have programs we can do as little as 3% down. And we have programs where we can do 100% financing. Okay, now that doesn't mean that you can get into the house with zero money in the bank, but it means that we may not need any of your money towards down payment. One of the other things that we might need funds for Second topic, closing costs. Okay. So how much are you going to need for closing costs? It depends. Okay. There's different programs require different amounts. Some of the closing costs themselves, some of the closing costs are fixed. Doesn't matter if you're buying a $200,000 condo or a $2 million giant colonial on 5 acres, your credit report is going to cost the same as the next person. Okay. Your appraisal up to about $1 million is going to cost the same, whether you're around $1 million or you're down at 200,000, 300,000. That's going to cost the same. Once you get into larger homes and larger dollar amounts, then the cost of the appraisal can go up. But generally speaking, most people wind up paying the same amount. It's not dependent on the loan amount. Okay. Then you have other closing costs that are dependent on both the purchase price and or the loan amount. So a couple of your biggest expenses, we have something called a mortgage tax. Those of you that live in New York currently, or if you've been looking into it, you should know, unfortunately, we are one of the heaviest taxed states in the country. If there's a tax, New York will find it. So we have something called a mortgage tax. There is only about 8 states in the country that have a mortgage tax. You guessed it, New York is one of those. Yay, us. So that's going to be one of your single biggest expenses at the closing. How much is that going to be? It depends. It's not the same throughout the state. There's a basic amount, and then each county can set their own limits. Generally speaking, the further you get away from New York City, the cheaper it gets, just like most things. Okay. So Westchester County's tax is higher than Dutchess County, which is higher than Columbia and Greene County. All right. So, but rest assured, regardless of where you are, that's going to be one of your single biggest things. And that's based off of your mortgage size. So back to the original example, obviously on $200,000, it's going to be a lot cheaper than on $800,000. Okay. The other one of your other biggest expenses is something called title insurance. Again, that's going to be based off of just the sales price and the loan amount. So the higher those are, the higher that goes. So that's where kind of drives me crazy when I'll read things online trying to keep up on the latest and greatest in the mortgage business. And I'll read things about how you should have X amount of dollars or X percentage of your purchase price set aside for closing costs. Those numbers could be wildly different depending on where you're buying and what you're buying. So your best bet when it comes to this stuff is just to talk to your loan officer. I'll use a couple terms interchangeably tonight: loan officer, mortgage specialist, senior loan officer, mortgage originator. They all mean the same thing. That's what Sean's position here is. That's on with us here tonight. And we have 11 loan officers here at Ulster Savings. They're all top notch. And whoever you want to talk to, you talk to. But you want to do that early in the process. When we talk about qualifying for a mortgage, it's not just your credit score. It's not just your income. It's not just your assets. It's the combination of everything that we look at. And this is one of the big ones: is your assets or your capital, how much you have to put down. Not to put down, I'm sorry, how much you have to use towards your project here. Okay. The next topic you see on there is escrow. So the term escrow is actually can be defined multiple different ways. All right. The way we're going to generally use it is escrow is part of setting up your taxes and in homeowners insurance, your property taxes and your homeowners insurance for the property that you're buying. Okay, so how much is that going to be? It depends. Geographically, again, even within the same counties, you could have wild swings in how much the taxes are from one town or one city or one village to another. So a $400,000 house in one town, taxes could be wildly different than a $400,000 house in another town. Okay, so your escrow is setting up where we're going to collect a certain amount of the annual taxes to put into an escrow account to go towards your next set of payments. Same thing with your homeowners insurance. Okay, homeowners insurance is relatively stable in that you're not generally going to see huge swings. If you're looking to buy a $200,000 house or a $400,000 house, your insurance is not necessarily going to be double. That's not the way homeowners insurance works. Relatively speaking, it's much more reasonable than things like your property taxes might be, but it's still an important amount for you to get. So it's something that we're going to give you an estimate up front, but then within your process, once you start narrowing down your home search and you get to a house that you're confident that you want to put an offer in and really look at moving forward with, you're going to want to get an insurance quote or two. Again, we have the insurance here in-house, but you're welcome to go to, we see all those stupid commercials about bundling home and auto and all that stuff. The dopey commercials, but it rings true. You generally do get a good discount when you do that. So if you have auto insurance and you want to go through your agent, you're welcome to do that as well. But that's how we're going to use the term escrow. Okay. The last topic that we're going to see under this capital is for reserves. How much do you need in reserves? Anybody want to guess? It depends. Some programs don't require any. So before I get into that, I want to define what reserves means. Basically, reserves is what do you have left over in savings after the closing. So you go, you sign your paperwork, the keys get slid across the desk to you. How much do you have left in your account after all that's done? That's what your reserves are. Some programs have no requirement. You could literally get down to 12 cents left in your savings account. We don't recommend that, but you could, and we'd be fine. Other programs do require reserves. Sometimes it's dependent on the program. Sometimes it's dependent on the type of property that you're buying. If you're looking to buy some kind of a multifamily, like a 2-unit or a 3-unit, and you want to have some rental income along with your living space, those generally require more reserves than a regular single family house does. Some programs just require reserves right off the bat. Other programs you may not qualify for, but if you happen to have some reserves, 6 months, 8 months, a year, then you may now qualify for that program. It may be what we call a compensating factor to getting you into the home. So again, it's something that you're going to want to talk to your loan officer, your mortgage specialist about upfront. You want to talk about it early. Make sure you're not going down a bad path. Okay. Now, this is talking about all the funds that you might need for the process. Where is this money going to come from? Well, we've got multiple sources that we can talk about here. So the first thing, very simple, your personal funds, cash on hand. So personal funds, your checking, your savings, your stocks, your bonds. I don't know if anybody has bonds anymore. You're talking about your retirement funds, okay? Pension plans, 401ks, things like that. If you can borrow against them, all right? If you have to, if it's a type of retirement account that you can't borrow against, but you can withdraw and get a penalty, it's an option for you. It may not be the best move for you, but if you have it available, so be it. So that's what we're talking about when it comes to personal funds, is basically anything that you have in your name that you have access to. It could be trust funds, multiple types of accounts, CDs, things like that. Whatever you have, that would be your personal funds. Now, you see I've written on there cash on hand. Now, cash on hand would be actual cash. So now you're talking about, I actually have, in the olden days, it would be a coffee can or a shoebox, might be what we called mattress money, because people would literally hide it underneath their mattress or in a pillowcase. So if you have cash on hand, generally that's not acceptable to use for your home buying process. Okay, so if you have, maybe you have a second job that you get paid in cash, or you just like to have, you don't like to put money in the bank, you like to have a lot of cash on hand, you're really old school with that. Strongest suggestion is you put it in the bank as soon as possible before you start your home buying process, before you go out and find your dream home. Get that money deposited. Most of the programs, we're going to be doing a 2-month look back at your bank statement. So if you go and deposit it today and you sign your contract tomorrow, and tomorrow you apply for your mortgage and we pull up your bank statement, we're going to see you only had $500 in the bank and now you have $5,000 in the bank. We're going to need to know where that money came from. And if it's cash on hand, then it's not traceable. Then we can't actually count it towards your money that's available. And this, not saying it could kill your deal, but it could certainly put a very big speed bump in your way, where we may have to wait those 2 months for those funds to get what we call seasoned before we can move on. So if you are the type that likes to keep a lot of cash on hand, and that seems to be getting fewer and fewer as we go to more and more digital funds with Venmo and PayPal and that kind of fun stuff, but I do recommend that you go and get that deposited as soon as possible. Now, if you're already in the process and you're in that situation, speak with your mortgage specialist, your loan officer about it before you do anything. Okay. There's ways we may be able to lessen the blow on having funds that just aren't usable. Okay. The next topic you see on there, gifts. Generally, gifts are perfectly acceptable if they're from the right source. Okay, so different programs have different requirements, but generally speaking, if you can get a gift from a family member, that's almost always acceptable. Some programs may allow like a family friend. Some programs may allow an employer. Okay, but some programs do not. So when you're speaking with your mortgage specialist and you're talking to them and they ask, well, how much do you have to put into this transaction? And you say, oh, I've got $50,000. Great. But if you don't specify, by the way, 45,000 of that is going to come from a gift from my boss, okay, that may not be acceptable for certain programs. So we want to make sure we're putting you in a program that does accept that. Okay, so just be open and honest. You're going to hear me say it a couple of times. Like, be open and honest about your circumstances. Assume we are going to find out somewhere along the line. You want us to know early, not a week before closing, that, oh, by the way, I have this situation going on, and now it's panic time, and now it's scrambled eggs of trying to figure out, okay, now we got to take you out of this program, put you in this program, and we may need more documentation and blah, blah. None of us want to go through that. Okay. We want to put you on the right path and stick to that path and make it as smooth of a process as possible. So gifts, just be honest about it. Okay. The next topic you see, seller's concession. So this is something most people, if you're not in a business, you may not know anything about. So basically a seller cannot give you money for down payment, but they can actually give you funds to go towards your closing costs. Okay. Now this may sound weird. It is a little bit of a weird concept. You're buying the house from them, you're going to give them a bunch of money, but they're able to give you some funds towards closing costs. Okay. So different programs have different limits on it. Generally speaking, you can look at 3% of the purchase price as a limit. So if you're buying a place for $300,000, they could give you up to $9,000 back towards your closing costs. Okay. How does that generally work? Is this, give the example we just used. You're looking at a house, you're bidding, you come to an agreement with the seller, you're going to buy it for $300,000. Maybe you qualify, your income is fine, your credit is fine, but you're a little bit short on assets. You're a little bit short on your closing costs and down payment funds. So you say, all right, if you can give me a $5,000 seller concession, I'll be golden. Okay, so what do we do then? You make the purchase price $305,000 with a $5,000 seller concession towards closing costs. You're now netting out still at $300,000. It's not really costing you anything extra. It's not costing them anything extra. Okay. There's a little bit of extra cost because there's a sales tax. Again, if there's a tax, New York will find it. There's a sales tax on the sale of the home, so now it's going to be based off of 305 instead of 300,000, and you and the seller can work out who's going to pay for that. But it's perfectly legal. It's done all the time. Pretty much every program allows some kind of a seller concession. It's just the percentage that's allowed will change depending on what program you're doing. So again, if that's something that you're looking to do, just talk to your mortgage professional, your mortgage originator about it up front, and we can make sure we're going down the right path. All right. The next topic, nonprofit grants or DPAL. This would be an agency like Eileen that we had on earlier from Pat Stone. Time to time, they have certain grants that are available. We work with other agencies that may have grants available. And then the other one you see, DPAL. You don't need to write this down, but DPAL stands for Down Payment Assistance Loan. Okay, there are certain programs that we work with where you may be able to borrow additional funds as a down payment assistance loan. New York State has a very nice program where so you can do 97% financing on a first mortgage, and you can get a 3% DPAL, down payment assistance loan, that can go towards your closing costs. All right. There's restrictions on it, and there's income qualifications and all that, but it's a nice little program that you can do so that now you can get into that house of your dreams. Okay. So there are these things that are out there. When it comes in general to grants, this is something that we are not necessarily going to have a list of available grants. We deal, as I said, all over New York State, and there could be different grants might only be available geographically. It might only be available in Orange County or Dutchess County, Ulster County, something like that. Sometimes it may only even be certain towns or cities may have a grant that's available for you to use. It might be something that is only available for certain professions. A teachers union might have a grant that's available to them or something like that. So that's not really something that we can keep track of 100% here. So that's just something I recommend on your own. Just Google it. If you know what area you're looking to buy in, do an internet search for Columbia County first-time homebuyer grants and see what comes up. Okay, that's just not something we're going to be able to offer a heck of a lot of assistance. Once you find one that you might be eligible for, you send the information in to your loan officer. They'll generally talk with me, or we have we have somebody else here in the office that also specializes in this stuff. We'll take a look at it and see if it's something that we can work with. It has been a very, very long time since one came up that we weren't able to accept. There's a type of grant, I'm putting it in quotes, where the seller puts $5,000 into an account with an agency, and then that agency turns around and gives us $4,500 of a grant. Those types of things were pretty much outlawed a long time ago. Every now and then I'll see one pop up, though. So something like that is generally not acceptable. But as long as it is a true grant from a nonprofit agency, generally we can accept it. The next one you see on there, the Homebuyer Dream Program. So this is a great program that we have. Excuse me. This is a great program that we have at certain times of the year. Okay, it's been around, I'm going to say, about 6 or 7 years now. Every year in the beginning of the year, we get an allotment of funds to give out. This is from a New York State agency. It's called Home Loan Bank in New York. You don't need to know that. But they give participating banks an allotment of funds, and then it's up to us to distribute them to our first-time home buyers as they come in. And again, there's income restrictions and some geographic restrictions and things like that. So for 2026, we got our allotment in February. We have used all of those up as of right now. But what happens is in September every year, this program runs from basically February through the end of August. At the end of August, the program is shut down. If there is any unused funds in the whole state, they get drawn back into a common pool, and any bank that used all their funds will get a few more slots available to them based off of how much money is available and how quickly they used theirs. I'm proud to say we have always used ours, and we have always gotten some more slots in September. So depending on where you're at in your home buying journey, if you're really just thinking about buying a house, if you're thinking you're going to start looking in another 2 months or so, then you might be a candidate for one of those grants that we might get come September. We never know how much it's going to be, but we have gotten some, fairly certain every year we've gotten additional slots. Last year we got 6 more slots. I think we had 15 at the beginning of the year, and then we got 6 more in September that we had to use with it from September to November. So, and we were able to use all those. We work really, really hard to make sure anybody that does qualify for grant is eligible, and we get you in and get those funds to you. So that can be a great boon to you, a huge advantage in trying to buy your home. That can go for down payment and closing costs. So can be a beautiful thing. Right this moment, I don't have any to offer you, but we should again in a couple of months. The last one that you see on there, Smart Move New York. This is a special program that we have. I won't say it's an exclusive program, but there's only 3 or 4 banks in our main area that we work in here in the Hudson Valley that even offer this. Basically, what it is it's through a non-for-profit agency that we work with, where they give you a second mortgage. We can get up to 25% of your purchase price as a second mortgage, and that 25% will go towards your down payment and the extra 5% towards closing costs. So if you're buying a home for 100, just to use very easy numbers, buying a home for 100,000, you would take out a $75,000 first mortgage. We'd take out a second mortgage for 25. We could actually do 25,000. We could actually do $30,000 as a second mortgage, 25 going towards down payment and 5,000 going towards your closing costs. So how does it help you to take out a second mortgage? Well, the rate on that loan is fixed at 3%. Okay. So any of you have done any checking of where rates are lately? Where are we? We're upwards of 6.5% right now on a basic 30-year fixed. So getting a second mortgage for 25% of your total purchase price at fixed at 3% is pretty appealing. Okay, that can help you out tremendously and help you either qualify easier for the house that you're looking for, or maybe help you qualify for a little bit bigger house because the total payments are going to be lower. All right. Again, there's some income restrictions on that. You have to be a first-time home buyer. Your credit has to be decent. There's some different qualifiers for that, but it's a great program that we have. And like I said, while it's not exclusive, you're going to be hard pressed to find another bank that offers that program in our area. So I'm really, really proud to say we've been on board with them. Again, it's been, I think it's been 8 years now, and we've helped dozens of families get into some homes that they may otherwise not have been able to do by using that program. Okay, they are a separate agency. It's somebody we will set you up with them, but they have their own counselors, and you will call them, go on their website, and follow their program simultaneously with us working on your deal here, so we can all get to the finish line together. Okay, and with that, I am going to ask my partner if I can find him on here. Bear with me here. I got to have Sean to unmute himself. And
Thank you, Dave.
see. Okay, good. We'll see what do we have in some questions in the chat box in regards to capital.
The two questions that we've received so far, the first question is from Candace. She's asking, what is the time frame to have funds entered in the bank, deposited in the bank, where it won't be suspicious?
Okay. I don't like that word, suspicious, but I understand where you're going with it. Okay. So most programs, we have to do a 2-month look back. Okay. So if you're applying today and it's the middle of June, now obviously it depends. Some banks, their bank statements are going to run from the 1st to the 30th. Other banks that could run whenever during the month. So depending on where your bank runs their statements, if your statements run as normal, from the 1st to 30th, 31st, whatever the end of the month is, then if you're applying today, we're going to be looking for May and April and May's bank statements. Okay, so if we see those any large deposits, then we need to get an explanation and we need to be able to trace them. Okay, so if you can't trace them because it's cash, then that's a situation where maybe we have to hold up and we got to wait. If you made it in May, then we may have to wait until we can get June and July statements before we can really talk about seriously moving forward with your application. So it's just something to take into account when you're looking at going out and shopping for a home and signing your contract. We'll talk about this a little bit more down the line, but when you sign your contract, the seller may have an anticipated closing date in mind already. They may not. Okay, it depends on what their situation is. If they're selling a house to buy another house and they need to close on that other house on a certain date, then they need to sell this house first. Then that could dictate how quickly your closing date has to come up. So it's just like I said, it's not necessarily a deal killer, but it is information we need to know up front if that's something that you're working on. Okay, so generally speaking, it'll be a 2-month look back. There are some programs where we may only need 1 month of bank statements, but I wouldn't count on that.
Okay. We've got a second question. The second question came from Katie and Steve, and they were just asking overall, you keep using the phrase, the program you're in, and what do you mean exactly by program?
Okay, so we'll get into this a little bit later on, but there's not just one loan program that everybody goes into, okay? There are different, and I'm not sure how else to say that. That's a good question. I never get stumped on these calls. So there's just different parameters that are available, and some of it depends on what your credit scores are, whether you're a first-time home buyer or not. what type of home that you're buying, how much you're putting down. There's all different factors that come into play where there's different programs where if you're looking, okay, so if you're looking to buy a multifamily house, you want to buy a 4-unit house, you're going to live in one and you're going to rent out the rest. We may be able to only go to 95% financing, not the 97% or the 100% financing we're talking about. If you're looking to buy an investment property or a second home where you're not going to live there, you're just buying it as like a vacation home, we may only be able to do 90% financing. That's a different program. And some of these things that we're talking about may not be available for those types of programs. So that's what I'm talking about it here. We'll narrow it down with you as you speak to your mortgage originator, your loan officer, as you speak to them, and so about what you're trying to do. Then we can start to narrow that tree down for all the programs that we have to just what really might work best for you.
That's great.
I hope that helps.
Last question that we had that came in on Capital was what forms can a gift come in? And would cash be acceptable in that instance?
Okay, so sort of. Okay, so what happens when we get a gift? There's a gift letter that has to be filled in by both the donor and the receiver of the gift. So let's say you're getting a gift from Uncle Joe. So we're going to fill in, Joe Schmo, Joe Schmo. I'm going to give a gift to my niece, Jane Schmo, whatever, of $20,000. The funds are in my account at XYZ Bank, and I will be transmitting them before closing. Basically, it's a form letter that we have, just fill in the blanks type of thing. Most programs, sorry to use that term again, but most programs, when it comes to a gift, we don't have to actually see where the money came from. Most programs, we don't have to see Uncle Joe's bank statement to see that bank come in there. You are certifying, you are signing that letter that, Uncle Joe is signing that letter saying, I have the funds in XYZ Bank. And that could be Venmo. I mean, nowadays, again, it could be Venmo, PayPal, Zelle, whatever. But so you are signing a piece of paper that says they have it, but for most programs, the gift funds really don't have to be traced that carefully. Okay, but again, just speak with your loan officer about it up front. We'll make sure you're in the right direction. Okay. Mm-hmm. All right, and with that, okay, some good questions. I'm encouraging you as you think of something, just go ahead and throw it in the chat room. Again, it's the only way I know for sure that you guys aren't all sleeping on me. I need to make sure, I need to feel some kind of energy coming back. So I appreciate the questions early on, and we'll keep going here. So our next topic, which is capacity. So in capacity, what are we talking about? This is how are you going to pay for this loan that we're granting you? Okay, so we're going to look at your current income. We're going to look at the history and stability of your income, and we're going to look at the sources. So what are your current income sources? Do you have a regular W-2 job, like a teacher or some kind of an administrator where you're just making a regular salary every week, every 2 weeks, what have you? That's nice and easy to calculate. Do you have fluctuating income? Are you an hourly employee? In some weeks you work 35 hours, and some weeks you work 40, and some it's 32. That comes into play, what we're going to look at. Do you have some kind of fluctuating income in terms of commissions or bonuses or overtime, right? Many of us working overtime, trying to save up money to buy our dream home here. So depending on what your circumstances are, that will dictate how much of that income we can use and what we need to document. You'll hear the term documentation. We're regulated to death in this business. Everything boils down to documentation. So one of the questions as a loan officer I would be asking you up front is, what are your sources of income? And say, well, I work at XYZ company. Okay, great. Are you on a salary or you're hourly? I'm hourly. Okay, how many hours a week do you work? Sometimes I work 30, sometimes 35, blah, blah, blah. Okay, do you have a minimum number of hours a week? We're going to play 20 questions in so many different directions with this process. It's just the nature of the beast here. It's not because we're curious and it's not because we're trying to be difficult. It's because it's part of the program. It's part of us figuring out how much you can qualify for. We don't want to qualify you for too much and then you can't actually afford it. And we don't want to cut it too low where you could actually afford a bigger house than what some other banks might qualify you for. So we're going to dig and we're going to dig and we're going to try to get to the right answer for you here. So we need all this information to do that. Okay. The more open and honest you are about it, the better numbers we can put together, the more realistic numbers we can put together for you. Okay. So when it comes to these things, say something like overtime or bonus income, what we're not going to do is just take your most recent pay stub and go, oh, great, this person worked 10 hours of overtime last pay period, so I'm just going to assume that that's what you make all the time. Well, that's not right, because maybe some pay periods you make no overtime. Maybe some pay periods you make 20 hours of overtime, right? So what we're going to do, any type of fluctuating income, we want to smooth the curve of that and average it over a longer period of time. So what do we mean by that? What I'm going to ask you for is not only your year-to-date pay stubs, but also your last pay stub from 2025 and sometimes even your last pay stub from 2024, because we want to see what kind of history you have of making this. If you never made commissions before and you just switched positions a month ago and now you're making commissions, we don't have any history to base an income amount for those commissions. Just because you had a great first month doesn't mean you're going to have a great second month or a great rest of the year. Some things are seasonal, right? Some people might make most of their commissions between October and December in the holiday buying season. So if we're looking at your income now, there's not much in the way of bonus or commission, but come the end of the year, it's going to be there. Well, if you've done that for a year or two already, then we might be able to use that. Okay. So again, it's a matter of us getting all the right information and then we can calculate it out for you. I don't suggest you spend much time trying to do it, because it would be very rare that somebody who's not in the business and doesn't have access to all the guidelines and programs would be able to necessarily calculate it accurately. Let us do it. It's what we do all day long, every day. Okay, we'll take a look at it and we'll show what you can use. If you just got a raise last month, if you're salaried, great. I'm going to just use your new income, whatever your raise is reflected as, because you're not going to go backwards on that. But if it's fluctuating income where you might do good one month and not so good the next month, again, we're going to average that out over a period of time. We're getting to the point in a year where we'll be able to use year to date. For the first quarter up until, the first 4 months or so, I'm not really big with using year to date income for things because it's too short of a period of time. It's only a couple of months. Once we get past the half of the year mark, then it's a much better reflection of where you're at now. So if you had an okay 2025, but you're just killing it in 2026, we might be able to average 2026s in with 2025 and get you a little bit more income to use to get you a little bit higher purchase price and loan amount. Okay. And I hope that makes sense to everybody. So we talked a little bit about what your current sources of income are, history, or not sources, but your current income, your history, and stability. Again, stability. You're on commission. You had a huge year in 2025, but so far this year, for whatever reason, it's just not working well for you. Okay. Well, we're going to have to take that into account. You wouldn't want us using just 2025's income level because you're not making that money anymore. We don't want to set you up to fail. Okay. It's an expression I've used hundreds of times with clients and with doing my trainings. Okay. We don't want to set you up to fail. We're so great. You can afford this $400,000 house and you close on the $400,000 house and you're eating mac and cheese for dinner every night because you really can't afford it. Okay. Yes. Mac and cheese is lovely, but you don't want it every night. Okay. You want to have some protein in there every now and then. So we want to make sure we're not setting you up to fail. The way we do that, again, is by averaging those types of fluctuating income over a longer period of time to make sure we're using a realistic number. Okay. Sources of income. So we talked about job income. There's many other sources of income, right? You're on a fixed income on Social Security or a permanent disability. No problem. We can use that. You are self-employed. We can use that. Now that gets a little tricky. Again, there's a formula that we use for self-employed. It's not going to be the top line number. It's generally not the bottom line number. It's somewhere in between. It depends on what you're writing off as your deductions and how you're writing them off. Okay, some deductions we can add back in, some deductions we can't. So if you're self-employed or you have rental income, anything like that, again, you want to get pre-qualified very, very early before you start going out and looking at houses, especially if it's that type of income. So make sure that we're sending you down the right path. Okay. You could be on, if you have, let's say you have unemployment income, can we use that? It depends. If you're some kind of a seasonal worker, like a blacktopper, okay, you're not doing a lot of business in January and February, especially the last 2 years, as miserable as our winters have been. You're not doing a lot of business there, so you might get laid off for those 2 months. Well, if it's every year that you're getting laid off for those 2 months and you're collecting unemployment, then we can add your unemployment in. But if you just got laid off 2 months ago from a quote unquote regular job, that unemployment we wouldn't be able to use. Once you find a new job, then we can use that job's income. Okay, so again, there's all these little bits and pieces that come into play when we're calculating out how much you can afford to qualify and where you should be in terms of your purchase price. Okay, so we talk about capacity. One of the main things I keep talking about is you being able to afford this house. Well, what does your house payment include? Okay. You're talking about your mortgage, so that's your principal and interest, but it's these other items that you see on the screen coming up here, okay? It's also your property taxes, your homeowner's insurance, and then if you're in some kind of a community, a condominium, a PUD, a co-op, then we'd be looking at the homeowners association, management dues, maintenance fees. All this rolled together is a term we call PITI, okay? PITIA, but we just say PITI. Principal, interest, taxes, and insurance is the general term that we use. Again, you don't need to write that down. That's just the common term in the mortgage business. So your principal and interest, that's in the loan amount that we're going to give you. The taxes, we're talking about your property taxes for the house you're looking at buying. Now, good thing about property taxes are they're public record. Anybody can actually find out what the property taxes are for the house that you're buying. We train our people here. We're going to go ahead and look those up for you because you can't rely. I can tell you flat out, do not rely on what's in the listing. Almost every listing will list a dollar amount for taxes. It might be right. More often than not, my experience is that it is not. A lot of realtors, the extent of the work that they'll do is they'll ask the person that's selling the home, hey, about how much do you pay in property taxes? Oh, we paid $5,600 last year. Okay, great. $5,600 will go into the listing. Don't count on that. All right. We want to go out to the actual county websites. We can find if it's in a village, we'll get the village tax, we'll get the town tax, we'll get the school tax, we'll get the county tax, and that's what we're going to qualify. We're going to take whatever that total number is, divided by 12, and that's got to go into your house payment in terms of qualifying. There's no markup on it. There's no setup fee or anything like that. If the taxes are $6,000 a year total, it's $500 a month. That's what you're qualified on. Same thing with your homeowner's insurance. Whatever you're going to get as your quote, you're going to get it. We're going to take the total amount for the year divided by 12. We're going to add that in as part of your payment, and that's for qualifying. If you're in some kind of a community, your homeowners association also comes into play. So if you're in a condo and the common charges are $350 a month, we're going to put that in there as well. Add all those together, that becomes your house payment. That's what we're looking to see if you can afford as one of our things. What we do is we calculate out what's called a debt ratio, okay, commonly referred to as DTI, debt to income. Again, you don't need to write this down, just for your information. So there's two ratios they use. The first is the housing ratio or the front end ratio. So it's that PITI payment divided by your usable monthly income. So the example you see on the board here, $7,000 in monthly income, principal, interest, taxes, and insurance. With this situation, your front ratio, your housing ratio would be 36%. Is that good? It depends, okay? It depends on how much total credit debt you have, and we're going to get into that in a second, okay? But that's generally pretty good. Most programs these days do not have a limit on the front end or housing ratio. Years ago, again, I've been doing this for 33 years now. When I started, for most programs, and there wasn't that many programs back then, you had to be at 28% of your gross income in order to qualify for a mortgage. It was very, very difficult to do, but that's the way things were back then. Then things got loosened up through the years. So a 36% is pretty good in most cases. That would be acceptable. Again, some programs don't even have a limit, but generally speaking, if programs that do, 36% is pretty good. That's just a random example. The other thing we're going to look at is your back end ratio. Okay. Now this is your pity payment, your house payment, plus all of your other credit debts. Okay. So this is when we run your credit report and we see what else you have on there. We're talking about student loans. We're talking about car loans, personal loans, credit cards, whatever minimum payment shows up on there. We're going to add all those payments together, add that to your pity payment, and that's going to be used to calculate out your back end ratio. Okay. You see the example on the screen here, your house payment. It's on my left screen. That's why I keep looking over there. Your credit cards, auto loan, total debt. In this particular case, you'd be at a 45% back end ratio. Is that good? That's okay. Some programs might be limited to 43% back end ratio. Some programs can go to 45. Some programs can actually go to 50. Now, there may be programs that go more than 50. We don't do that here at Ulster Savings. And even 50%, think about it. On paper, it's 50%. In real life, it's quite a bit higher than that. Think about it this way. What did I talk about? I talked about your gross income. Okay, we're not talking about your take home. Talk about your regular W-2 employee. Again, let's say your teacher, you're making $80,000 a year. We're going to divide that. Should have used an easier number. We're going to divide that by 12. That's going to come up with your income. Let's say in this case, you got $7,000 a month in income. Now I know that's $84,000 a year. It's $7,000 a month in income as your gross income. Well, is your gross and your take home the same? Generally not. I know for me, I've got federal taxes, state taxes, you got Social Security, you got Medicaid, you've got health insurance, you might have 401k coming out, you might have some other kind of supplemental insurance coming out, you might have a garnishment coming out, right? There's all kinds of things that are coming out. So your take home pay and your gross pay are two different numbers. We're allowed to use your gross pay. That's what we're going to use. Okay, so 45% of your gross pay is going towards these payments. What is your real life net take home pay going towards? Probably something more like 60, 70, 80% once you do the math. Now you have to decide if you're comfortable with that. The other thing that you want to take into account, we're only talking about your house payment, your future house payment, plus your credit expenses. There's plenty of other expenses that we're not taking into account, okay? Little things like food, your electric bill, your phone bill, clothing, if you're paying for gas or electric, oil bills, things like that. If you're not putting them on a credit card, we're not taking those into account. So those are all things in the real world budget that you need to take into account that we're not. All right. So again, we don't want to send anybody up to fail, but we are heavily regulated with what we do and don't look at. And we're looking at your house payment plus what we see on the credit report, plus any other credit expense that you disclose to us. Okay. We'll take that into account, and that's your number. So like I said, some programs that might be 43 max, some programs 45, some programs go to 50, and then it's up to you. We're going to tell you what you qualify for. It's up to you to decide what you're comfortable with, because you're the ones that need to make these payments every month. Okay. Keeping in mind, taxes and insurance don't generally go down, right? So you buy the house this year, next year you get a new tax bill, or actually come up, say you're closing now, they're going to base it off of the tax bills came out in January and September, most of the areas around here. Well, come this September, you're going to get a new tax bill. It's probably not going to be lower. Sorry to break it to you. That's not the way things are going. All right. So just take that into account. All right. On that note, I am looking for Sean to unmute himself, and let's see what kind of questions we have in the chat box while I give my voice a rest for a quick second.
We have two questions that seem related, but they are two distinct and different questions.
All
The
right, let's
first
hit 'em.
question is from Candace. Candace is asking, what happens if you have a stable job, but then you change for a better opportunity before or during the loan process?
Okay, good question. So if it's during the loan process, definitely speak to your loan officer before you finalize it. Okay, let's just make sure there's not going to be a major impact on you. If it's before you're doing your thing, and either way, my standard answer is it depends. Again, my team hates it when I say that. You're going to get sick of hearing me say that, but it is what it is. So, what is this new opportunity? If you're going from some kind of fluctuating income to a salaried job or a salaried job to a higher salaried job, great, no problem. We're just going to use the new income. As long as you start the new job before your first payment is due, most programs, I have to put that little asterisk on there. As long as you start the new job before that first payment is due, then generally speaking, we can just use that income. So no problem. Now, there's some qualifiers on that. We're going to get your offer letter, whatever offer letter you get from the company you're going to send to us. Oh, well, they didn't really give me an offer letter. They just talked about things verbally. Well, that's not something we're going to be able to use. Okay. And obviously, you should be looking to protect yourself. Also, you should get everything in writing. So you get your offer letter, and we take a look at it, and it says it's subject to background check and drug testing. Great, no problem. We move on. Now, if it's subject to anything else, I'm trying to come up with a good example here. This isn't something we run into very often, but if it's subject to any type of qualifier, like you getting licensed, okay, you're going to take a job as a financial advisor, but you have to get licensed first. Well, that we're not going to be able to accept, because how do we know if you're going to get licensed? Are you going to be able to take the test and pass the test and all that fun stuff? Okay. So it does depend on what you're going to. Now, where we really run into trouble is when people go from a salaried position and they think it's a great opportunity, but it is what we talked about earlier about the fluctuating income, right? So you're going from a salaried position, say you work in the service department of a car dealership, and you're going to go to become a car salesman. Well, yeah, the idea is that you could make way more money. Trust me. And very early in my life, I was a service writer for a car dealership. So I wouldn't blame you for trying to get out of that job. But if you're going to that, now we don't have any history of you making commissions. Oh, my manager says there's no way I'll make less than XYZ. Well, sorry, but there is a way. If you don't sell enough cars, you may not make that. So that's not something we'd be able to use. You're going to have to establish yourself in the new job, probably for a full year before we can, at least a year before we can do anything with it. Okay, this goes back to the topic we had before of we don't want to base everything that we're doing off of a great month or a bad month. We want to smooth it out. Well, if you don't have any history, it's tough to do that. If you're going from an hourly job to another hourly job, what we're looking for, or you're going to any type of hourly job, what we're looking for is, do you have a guaranteed minimum number of hours? Okay, so my hours will fluctuate, but I'm guaranteed to work at least 35 hours a week. Great, we're going to take 35 hours a week. We're going to multiply it by your hourly amount. We're going to use that. All right, now, we may have to see a pay stub or two to make sure you really are getting that money. But if your offer letter has it, we can get something from the company stating it emphatically that that's what you have with no ambiguity in the letter, we're probably going to be able to use it. Okay.
All right. So the second question that was similar was from Katie and Steve, asking how might things be affected if you're looking for a home while you're on a maternity leave and not receiving a full salary, but you're going to be returning to work?
Okay, well, congratulations. I'll assume that this question is being asked for a reason. So it does depend, but generally speaking, that's not an issue. Okay. What we're going to do is get some additional information from you and your employer of what your anticipated return to work date is. If your anticipated return to work date is before your first payment's due or before the loan is closing, or is it going to be after that? There are some qualifiers, but generally speaking, something like, and not just maternity leave, but any type of short-term disability, we're going to be looking for some information of when you're expected to return to work. Are you going to be, and are you expected to go back to work at full capacity? Plenty of people will go out on short-term disability for one reason or another. They were full-time and now they're going to go to part-time. That's something we're going to have to take into account. And what is that part-time? What does that mean? Does it mean exactly 20 hours a week? Is it fluctuating? So again, there are some different factors in that. That really does come down to a individual case-by-case basis. But generally speaking, that's not a problem for us with most programs. Okay. Anything else with capacity?
Don't think so.
Okay. There's only 2 questions that time, guys. Again, got to make sure we're paying attention here. You don't want me to make Sean get up and start singing and dancing to get your attention. So let's make sure we're filling up that chat box a little bit more. I need to make sure you're all with me. All right. Third C, credit. Ooh, scary. Okay. So, and Eileen talked a little bit about this, about being, mortgage credit worthy. What does that mean? It depends. Different programs have different requirements. It doesn't mean you don't have to be pristine. You don't have to be, I missed a credit card payment a year and a half ago. I don't know if I'm going to be able to get approved. That's probably not even an issue. Okay. I've seen the whole gambit. First off, again, I've been doing this over 33 years now. I'll never say I've seen it all, but I've seen pretty much anything you can throw out at me in terms of what's good and what's bad. So don't be shy when you're talking about it. We are going to run our own credit report, but don't be shy about discussing this with your loan officer so we can maybe set up a plan and make sure we're going in the right direction with you. But the bottom line is there's a whole bunch of factors that we're looking at when it comes to your credit. So one of the first things is credit score. Now, fortunately, credit score is becoming less and less important from a do I or do I not qualify standpoint. A lot of programs do not have a minimum credit score anymore. There are still some programs out there that do. Most of them are really looking at the quality of the credit over and above the credit score. I've seen people with a 700 credit score that I wouldn't want to lend $10 to. I've seen people with a 640 credit score that I didn't think were an issue at all. Okay. And this is what I do for a living. So the credit score can often not be a great real world representation of what your situation is. So fortunately, some programs have done away with that. Now, again, it doesn't mean we're not looking at the credit. We're still going to see what's out there. So now where your credit score can come into play with a lot of programs is in, I'll call it the pricing, or on your rate and your fees for getting the loan. Generally speaking, for most programs, the higher your credit score, the better the rate or the lower the fees are going to be for that program. So somebody with a 650 score, somebody with a 750 score, they might both qualify for the program, but the 750 might be able to get a better rate out of it because they've earned it with that higher score. Okay, so sometimes it's not a matter of pass fail. It's just a matter of how much it's going to cost you, and are you still in a position to be able to do something? Okay, so what is a good credit score? Tough to say. Generally speaking, for some programs or when it comes to the pricing, 780 and above is the top box. Now, it doesn't mean that that's a good score. That's the only score that you need. But a 780 and above is generally the top box. If you're a 780 or higher, you're getting the same program. Every 20 points below that puts you into a slightly different tier. Okay. Some tiers might not be any difference. That tier might be 40 points or 60 points. Other times it might be 20 points. All right. Again, depends on the program, depends on what the situation is. All right. So it is important, but it's not necessarily, like I said, a pass fail or a deal killer. All right. That being said, if you have a credit score in the 500s, the quality of what we see on the credit report is probably low enough that we're going to have a real challenge trying to find a program for you. All right. That's just the nature of the beast. Okay. And we'll get into what goes into the credit scores in a little bit. It's kind of all these things we're going to talk about. So the next thing on the screen you see is frozen or locked bureaus. So if you had a situation where you had to freeze your credit bureau because of fraud, or just because you got nervous about, you hear about all these horror stories about fraud or misrepresentation out there, and so you froze your credit bureaus, just have them unfrozen before you have us pull your credit. Otherwise, we're going to pull the credit. It's going to come back and say couldn't give you the credit because it's frozen. Then we got to get back in touch with you. Now you have to get in touch with the credit bureaus. Now we got to wait for them to unfreeze it or unlock the credit. And then we got to try to rerun the credit again. Days could go by as we're going back and forth with this. So just have it unfrozen, have it unlocked before you ask us to run credit. Be aware of that. Obviously, the next thing on there is fraud alerts. Very simply, if you've had some kind of a situation where somebody got a hold of your number and there was some accounts that weren't yours, you place a fraud alert on your credit report. That's fine. What you need to make sure is that your information is current. Okay. If you have a fraud alert, what it does is it doesn't mean that we can't pull credit, and it doesn't mean that we can't move forward, but it means we can't move forward without calling you. It'll say there's a fraud alert on my credit. Please call this number to verify I applied for this loan. We're going to call that number and we're going to ask some qualifying questions. Can you tell me who you have your car loan with? Can you tell me what's the oldest credit card on your credit on your statement? Something like that. Well, if the phone number that you have listed there isn't your current phone number, then we can't get in touch with you that way. It's not a deal killer. It just makes it harder for us to do what we need to do. And if you're under the gun, you found a house that you fell in love with and you want to get this going quickly, you don't want us to have to go back and forth trying to figure out what's going on with the fraud alerts. Just we're going to talk about you pulling your own credit to see what's on there. When you do, if you have a fraud alert, just make sure the phone number is up to date and it's your right phone number. We don't see this too much anymore, but what we used to see years ago, people would have their home phone number on there, and then they'd get rid of their home phone number and only go with the cell number. And now we have to find another way to get in touch with you. Okay. Credit history. We talked about this a little bit before. That's by far the most important factor in determining whether or not credit-wise you're going to qualify. What are we seeing on your credit history? What's your payment history? What type of accounts do you have out there? And what kind of usage do you have? So very simply, the more payments that are paid perfectly, the better. Okay. The older the accounts are that you have, the better. The lower let's talk about for like credit cards, revolving accounts, the lower your balance is compared to your total available credit, the better. Let me explain that. Let's say a lot of people, there's a lot of misinformation when it comes to credit out there. I want to take some time and explain this in detail for you. So let's say you have $3,000 in credit card debt. You have 3 or 4 cards, and between all 3 of them, you owe $3,000 in credit card debt. Is that good or bad? It's neither. Okay. I mean, I guess any debt is not great, but it's neither good nor bad. It just is. What's going to matter is, what are your credit limits? If you owe $3,000 and your total credit limits between those 3 cards is $3,000, you're maxed out. Your credit scores are going to plummet because it looks like you can't manage your available credit. You've got a credit line, you ran it up to the limit, and you're living at the limit. That's not, as far as the algorithms go, that's not a good sign. Now, you might be going, my minimum payment's $200. I can afford that all day long, every day. Great, but why are you at the max? Okay, nobody wants credit card debt. Generally, it's our highest interest rates, right? And it's not the principal that kills you, it's the interest. So if you're living at the max, or you owe $3,000 and between all 3 cards, your limit is $3,500, you're still at almost 90% usage. That's not great. So your credit scores are going to be affected by that, and our willingness to lend you money are going to be affected by that. Same dollar amount, you owe $3,000, but your total credit limits are $10,000 combined. So you owe $3,000, but you have $10,000 in total limits. You're under 30% of your limit. That's top box. That's great. Your credit scores are going to be higher. And we're going to look at that as though you're able to manage your money. So it's not about the dollar amount. It's about the percentage of how much you owe compared to what you could owe, basically. Now, when it comes to fixed loans, your student loans, your car loans, things like that, obviously you can't control the credit limit. The credit limit is what it was when you took it out. That's it. Every month that you pay, you're paying it down. So the longer that you have those accounts, the better your score is going to be. You go out and open up a new account today, your score is automatically going to drop just because it's a new account and you don't have any history on it. Now, I'm not saying it's going to plummet, but it's going to drop. Now, you have that car loan and you make all your payments on time for a year, your score is going to improve quite a bit from where it was a year ago when you took out that loan. Okay? So there's things like that come into play. One of the pieces of advice I always give, people get nervous and they read things. There's a lot of misinformation out there when it comes to credit and credit reports and all that stuff. One of the things I've read, and it makes my head ready to explode, do not cancel out your credit cards. Okay? Do not cancel out your credit cards. I'm going to say one more time. Do not cancel out your credit cards. I'm fairly serious about this. One of the problems I've seen throughout my career is before somebody comes and sees me, when I talk about the credit with them, I'm like, oh, well, I just closed out all my credit cards. That's good, right? No, that's bad. Why is that bad? Because now your credit limit is exactly what you owe because the account is closed. You can't charge any more on that. So your $3,000 is now limited to the $3,000 limit because you closed it out. You're at 100% usage. Your score is going to drop. The other part of that is once you cancel out a card, now you're not getting credit for the fact you might have had a card for 5 years, 10 years, whatever. All that history basically is out the window because it doesn't exist anymore. It's closed out. So you just hurt yourself two different ways by doing that. Now, you want to not use your credit cards? Awesome. Beautiful. Love it. Just don't close it out. Pay it off, pay it to zero. Every now and then or even if you do it monthly, charge a tank of gas, which now, what, $80, $90? Charge a tank of gas, pay it off the end of the month. Great. The credit bureaus, when it comes to scores, they're not judging you based on how much you charge. They're judging you based on how much you owe compared to what that limit is. Remember? So don't close out your credit cards. Try to keep your balances on credit cards down so that your credit limit, you have some room between what's owed and your credit limit. And it's cumulative. You can be maxed on one card, but have 100% availability on another card. It's just the balances are going to get added together. So don't worry about spreading the wealth and all that stuff. Okay? So two big parts of that. As far as the rest of credit history goes, kind of goes without saying, the more accounts that you have with perfect credit history, the better your score is going to be, the more likely we're going to be to want to lend to you. If you start getting some delinquency, then that shows that you're having trouble managing your money now. How are you going to manage your money with a bigger house payment? Okay, so that's something that's taken into account. The number of active accounts, this is a minor thing, but I like to go over it. Some programs, you have to have at least 3 trade lines. Okay, so a trade line would be whatever's on there, a credit card, a student loan, a car loan, whatever. Each one of those is a trade line. Some programs require at least 3 trade lines. What if I don't have 3? Well, then I should have this in a different order. Then we're going to go down to that last checkbox of alternative sources. You have other things that you're paying on that we are not seeing on the credit report. Things like a cell phone bill, things like your car insurance, your streaming services, your Netflix or your Spotify, whatever. If we can show through other means, not just a credit report, that you've been making payments for 12 months, then we can use that as what we call a trade line, and that can add in for those programs, okay? You also have the ability to add trade lines onto your own credit. It's called self-reported credit. There's third-party companies that'll help you to do that. I don't have one that I recommend. It's just something you can do an internet search for, and you can find out. But if you don't have that many trade lines, it might be a good idea to do that. You might be able to add your rent. If you're renting from a place, you might be able to add your rent. Like I said, cell phone bills, utility bills, Netflix, we've seen all that stuff on credit reports before as self-reported. So that's a way that you can help to increase your credit scores, increase the number of trade lines that you have, and make it easier for us to do our job and to put you into a better program. The other thing, delinquency kind of goes without saying. just because you have a delinquent or two account doesn't mean that it's a deal killer, but we'll go by the severity of it. Okay. 30 days late on a credit card doesn't mean anywhere near as much as a car being repossessed. Okay. Or if you have a foreclosure or you have a bankruptcy, you have some kind of a serious event on there, obviously it's going to have a much bigger impact, and it might be a stop sign. It might be a deal killer for today, but we can put you on a path where maybe down the road we can get you into a home. Okay. So once we take a look at the credit and we see what it all entails, that's where we're going to get into that kind of information. Now, the last thing you see on here, and I do want you to either write this down or take a screenshot, annualcreditreport.com. Okay. Annualcreditreport.com. This is government sponsored website that you can pull your own credit report. Okay. This will be what we call a soft pull. All right. So it means you can pull your credit through there. It will not show up as a credit inquiry. If you do that today, and then next week you come in and you see Sean and you let him pull your credit, when we pull your credit, we are not going to see annual credit report on there as a credit pull. This allows you to pull your credit for free. The parameters of this have changed a little bit over the years. So I apologize. I'm not necessarily up to speed, but it tells you right on the website. You can at least get one credit bureau from each of the three main credit agencies every year for free. I think you can actually do it once a month for free now. It used to be once a year. I think they changed that to once a month, but you could take a look at that. That might be overkill. I don't know that you need to do it that often, but it's a good idea for you to take a look at it. Now, you're not going to get your credit score this way, but what you are going to get is everything that shows up on your credit report. You don't want, when we pull your credit report for the first time, you don't want that to be the time to find out that there's a fraudulent account, that you have a car loan out there for $800 a month that you didn't know about. Okay, you don't want us to be breaking that news to you. We don't want to be breaking that news to you. Okay, so go out there, take a look at your credit, see if there's anything that seems to be misrepresented, make sure everything looks correct. Generally, you can get a phone number for any creditor that's out there, so you can reach out to them and say, hey, XYZ Bank, you're reporting me with this account. I don't have an account with you. And they go and look, and it turns out that it's you had some dental work done and they did financing with you. It might be through an agency that's got a different name, and that's on the credit report. So you might find out that it is actually yours. Okay. But I highly recommend that, annualcreditreport.com. Now, there's other sources that you can use. Some of the ones we see commercials for from time to time. I don't endorse any of those other companies. I'm not saying they're good or bad, but I don't know what the accuracy of those types of companies are. One thing you can do, and I also suggest, I know most of the credit cards out there, they have a free service where you can get a credit score. It's generally only one score. All right. We're going to look at all three credit bureaus, and we're going to look at all three of your scores. They're generally only going to give you one score. So that is not the do all and end all for looking and see what are we going to see when we pull it. But what it can tell you is a trend. So if you went out there in January and you pulled it through, like I said, your credit card, and actually, if you bank with us, I know on our ulstersavings.com website, if you bank with us, you can have your credit pulled through us with one of the bureaus. And most of your credit cards do that. Excuse me. So what it'll do, it will give you a score, but it may not be the score that we see. But if you did it in January and your score was a 650 and you worked on some things, and you did it in April and your score was a 680 and you did some more things, and you did it today and your score is a 700, that doesn't mean if I pull it today, I'm going to see 700, but it means I should follow the trend. The score should be higher now than it would have been if we had done it back in January. So you can see what trend. Is it going up? Is it going down? You can generally see why it's going up or down. It may give you some of that information. Okay. But that's all very helpful for you. Doesn't do anything for us. We can't take that credit report, whether it's annualcreditreport.com or your credit card or whatever. We can't take that credit report and do our thing. We have to pull our own. But at least you shouldn't be surprised by whatever we come up with. Okay. And I shouldn't even say what we come up with, what we see. We have no impact on your score or anything like that. We just use a third party agency and we go out and pull the credit. Okay. So that's everything I wanted to go over in terms of credit. I know that that's a big topic for everybody. I'm going to go ahead and turn it back over to Sean and see what do we got out there. Any questions in regards to
We do have a
credit?
couple of questions about credit. The first question came from Gabriella, which was just sort of an overall question. How much does a credit score impact closing costs? I think you talked about this a little bit. Yeah. How much does a credit score
What's my
impact closing
favorite
costs?
answer?
Yeah, it depends.
What's my favorite answer? It depends.
Yeah.
Okay. Like I said, if you're a 760 instead of a 780, it might not have any impact. It might have a little bit of an impact. If you're a 660 instead of a 780, it might have a bigger impact. There are some programs where it has no impact.
Yep.
So we won't know until we get in with you and work up that custom quote for you.
All right. Peter was asking a question. What if you pay off all your consumer debt, but your credit score is still dropping? Should I keep a small revolving debt to keep my score up? This is part of what you talked about, I think, but definitely a question.
A little bit different angle. So, okay. So it depends on what you paid off. Again, my favorite word, depends. Depends on what you paid off. If you paid off loans, those by their very nature, they have an end date. And once it's paid off, it's paid off. It's closed out. So your score could drop a little bit by paying off your loans. I would be surprised to see that. When it comes to credit cards, if you're paying them off but not closing them out, it should not affect your score negatively. I'm thinking there's something else going on there that I would want to see what was going on there, why your score would drop. If you paid it to zero and you don't charge anything up on it again, but you didn't close it out, your score should not drop. I can't think of any circumstances that would happen. So I would say maybe we need to do a follow-up offline and take a look at what's going on there. But and like I said, if you closed it out and you have no active accounts, that's going to make your score drop a little, certainly. The other thing, when I talk about the whole thing with the credit cards, again, pay it to zero. I don't want you to see you carry balances. If you have a credit card and you get your miles or you get points or you get cash back on it, by all means use it. Just don't care if you're in a position to pay it off in full every month, pay it off every month, and you should be okay. All right, that should not affect your scores negatively. So yeah, if you want to follow up with us, I'm going to have a email address at the end of the presentation that you can reach out to us on. Be happy to take a look a little more deeply at that.
Last question that we had about the credit was, if you're in the middle of a bankruptcy, how could that affect the process?
That's going to affect your process pretty significantly. So yeah. Now, favorite answer, still depends. What type of bankruptcy are you doing? Is it a Chapter 7 or is it a Chapter 13? So what happens with a bankruptcy is, from the time that your bankruptcy is discharged, there is a waiting period before we can take out a new credit for you from a mortgage standpoint. How long is that period? It depends. It depends on the program. Depends on what type of bankruptcy you have. So again, something that's that specific, I don't want to get into too much detail here, but you can talk to your loan officer, talk to your mortgage professional, and we'll be able to point you in the right direction on that. All right. Good questions. Good questions. I like to hear it. All right. With that, we're going to move on. We're getting a little tight on time today. I must have gone a little slow. So we're going to try to get through the rest of this here before our time limit. So our fourth C is collateral. Collateral, that's the property that you're buying. So earlier I said the house that you're buying may not be a house. It might be a home. So what are we talking about? We're talking about single family houses, 2 units, 3 units, 4 units. Is it a condo? Is it a co-op? Is it a townhouse? Is it a manufactured home? Is it a modular home, right? All different types of homes that we can have here. So what we're looking at is we can do pretty much any type of home. We do not do co-ops. Okay. Co-op is a different animal. All different types of laws and regulations when it comes to co-ops. So we don't do them here. Sorry, if that's what you're interested in. Mobile homes have some restrictions on them, whether it's a single wide or a double wide. If it's been moved, if it's on a permanent foundation, we can't do a mobile home in a park. When you're buying a mobile home, you have to also be buying the land underneath it as all one package. And the mobile home has to have been built after June of 1976. Okay. If it's built before then, we generally cannot finance it here. I won't say definitively, but generally cannot. There was certain restrictions or certain regulations that were put in place by HUD at that point. Don't want to get into a boring topic with you there. This is my mortgage nerdity coming out. So we'll move on from that. But otherwise, again, single family house, 2-unit, 3-unit, up to a 4-unit house is still residential. If you're looking at a house that's 5 units or more, that becomes a commercial loan. And a commercial loan is done through our commercial lending department. Funny how that works. Not by us. Now, we have a very good commercial lending department. We're happy to refer you over to one of our partners there. But most of what I've talked about tonight does not apply. Commercial lending is a completely different animal than residential lending. Most people, not banks, but most people that do one do not do the other. It's you're either a specialist with commercial, you're a specialist with residential, and that's the way that it is here. What are we looking at when it comes to the home? We're looking at the condition of the home. So what's going to happen is within the process, for most deals, we're going to send an appraiser out to the house. The appraiser is an independent third party that's involved in the transaction. We're going to order it. You're going to pay for it, but it's not a bank employee. One of the things that drives me crazy is I'll hear a comment, and again, this is whether it be from some of the online or some of the networks that I belong to, where somebody say, "Oh, such and such bank appraised my house, and they had it come in really low." Okay, well, banks in general, and I'm not here to defend anybody but Ulster Savings. In general, banks don't do appraisals. We hire out an independent third-party licensed appraisal that's familiar with the area that's going to come out. They're going to come out to the house. They're going to look at the house. They're going to come into the house. They're going to snap some pictures. Most of their work is then done back in their office. They're going to compare the house that you're buying to anywhere from 3 to 6 other houses in the area. They try to make it within a mile. They try to make it within the last 6 to 12 months. If you're in a real remote area, we might have to go beyond those parameters, but they're going to compare it to the houses that have sold and what is the cost of those houses. They're going to look at the square footage. They're going to look at the bedroom and bathroom count. They're going to look at the acreage. They're going to look at the location. We're not going to compare a house in the city of Poughkeepsie to a house in Saugerties, right? Doesn't make any sense. They're two totally different markets, right? So that's what the appraiser is going to do. They're going to prepare the report. They also look at the contract. So they're going to see what types of things are being included. They know what the sales price is, and they know what's included. Is there any personal property that's included? Is there any seller's concession we talked about earlier that would impact the value? Those types of things. So they create this report, they get it to us, and then we see what the last topic on there, you see the condition and the fair market value. Okay, something's value is not what one person would pay for it. It's what the average person would pay for it. So you're going to sell a car and it's a 1963 Volkswagen Beetle. You love that car. You poured $20,000 into that car, fixing it up, making it all nice and cherry. Guess what? I'm not paying $20,000 for it because I have no interest in those cars. I used to work on them. I hate them. But some people might love that car and they might be willing to pay $20,000, $25,000, $30,000, whatever. But something's value is not what one person's willing to pay. It's what the average person's willing to pay. You're trying to sell your house and it's a purple house with pink polka dots because that's what you wanted to make it. That doesn't mean anybody else wants that house. That could hurt the value of your house. Okay. So the appraiser is going to take those types of things into account. Some of it is very quantitative. How many bathrooms, how many acres, those types of things. Some of it is objective. Okay, what color schemes do we have going on there? Is it classic? Is it modern? those types of things. So all that comes into play. So the appraiser is going to be comparing that, give us the report, see where the value comes in at. Now, when we go to lend, we're lending off of the lower of the sales price or the appraised value. So let's say you agree to a sales price, you find a house, you fall in love with it, the list price is 300,000, you bid 300,000, and they come back and say, "Oh, we got 3 other bids, so you're going to have to up your bid," and you get into a bidding war, and now the final price winds up being 320,000. The appraiser goes through and does their job, and they say the value of this house max is 310. There's just no houses for 320 that are under the parameters of what you found. It's 310. Well, we're going to lend based off of the lower two. So let's say we're doing 100% financing. We're not going to lend you 320. We're going to lend you 310. So what about that other $10,000? Well, maybe if you have the extra money, you could put that money down out of pocket and get it down so that we're going to lend you the 310 and you're going to pay the 10 grand out of pocket. Or you go back to the seller and go, "Well, the appraiser came in at 310. We need to renegotiate this down." The seller can say, "Okay, we'll negotiate down. We'll meet you halfway. We'll come all the way down." Or they might say, "Nope, we had 2 other offers right in the same ballpark. We're going to put the house back on the market." Legally, there's really not much of anything you can do about that. Okay, so some of it is a personal decision where you got to decide how much you're willing to pay for that house, and some of it is how much the seller's willing to work with you on it. Okay, we have no role in that whatsoever. So a lot of people will come to us because we've developed a level of trust at this point and say, "What should I do?" And like, "Hey, I can't tell you what to do when it comes to this. It's your money. How much do you love this house? What are you willing to pay for it?" One thing I always say you want to look at is, do I want to overpay for a house right off the bat? Again, it depends on how much you fell in love with this house. If it's a house you think you're going to keep for 20 years, maybe it makes sense. If it's a house you're going to look to be in just for a couple of years and then sell it, maybe it doesn't make sense. That's up to you. So that's what we're looking at. As far as condition goes, it doesn't have to be immaculate. If it's not new construction, we understand, there might be cosmetic issues with the house. There might be stains on the wall or marks on the wall from kids running into it or whatever. The carpeting might be old and kind of worn out. The hardwood floor scratch. That's fine. The only thing we're really looking for when it comes to condition is health and safety issues. Is there a water stain on the ceiling? What does a water stain mean? It means that there's a water leak. What comes with that? Mold. Okay, there might be a mold issue. Might not be a deal killer, but maybe we got to get a mold remediation company out there to certify that there is no mold out there. We might need to get a plumber's write-up saying they fixed a leak, or a roofer's write-up saying they fixed a leak from a roof, something like that. Broken glass, missing handrails, a deck. We've had 2 in the last 3 weeks, 2 different situations where you couldn't even walk on the deck. It was so rotted out. That's a health or safety issue. We can't close the loan that way. Okay, the seller is going to have to remedy it, or you're going to have to remedy it. Something's got to be done there. Okay, so health and safety issues, that's really what we're looking at when it comes to condition. Otherwise, as long as the house is functional, we're good to go. All right. We're going to move on here because we are running very short on time. So again, you could take a screenshot of this. This is the general steps of getting pre-qualified by Ulster Savings. Generally, it should be your first step in the pre-qualification process. The first step in the home buying process, really, not the pre-qualification process, is come see us or contact us online. You don't want to find a house, fall in love with it, and then come to us to see if you can afford it, and we have to crush your hopes and dreams. Nobody wins in that scenario. It's the last thing I want to do when I'm talking to you. All right. We want to make sure we're setting you up on a realistic path. All right. So should be your first step. You're going to find out what your buying power is, find out how much you're going to need to put down, because we're going to look and see what programs you qualify for and don't qualify for. Are we going to be able to hook you up with one of our partners like Pathstone or one of the other housing agencies? Maybe there's some grant money out there. You want to know what your new monthly payment is. Most people talk about a new home in terms of, can I afford a $400,000 home? Well, it's not the $400,000. It's what is the monthly payment on that? Okay. So that's what we're going to do. We do have an online pre-qualification process. 2 o'clock in the morning, you decide that's the best time for you to get pre-qualified, you can go out to ulstersavings.com and you can fill in your information. And if everything fits, you can print out your own pre-qualification letter right there. And then I do need to make notice this big warning at the bottom. A pre-qualification is not a commitment to lend. Why not? That seems contradictory. It is not. We're pre-qualifying you off of information today that you're telling us and that you're providing to us, pay stubs, bank statements, credit report, that type of thing. If it takes you 4 months to find a house, and in that 4 months you change jobs and you went from having a salary to being all commission, I can't guarantee you that we can still lend that money to you. Okay. Any type of major financial situation that you have going on, just check in with us. Just say, hey, this is what's happening. What do you think? Is this a problem? Is this an issue? Let us work on it up front. Don't wait until we're deep into the process. Okay. The other thing is there's things that are outside of our control. The situation we just talked about with the house. You're pre-qualified, your income, your assets, your credit, everything works. The appraiser goes out to the house and finds out that there's big holes in the deck because somebody fell through. Okay, we're not going to be able to lend on that. It's just not something that's within our purview of doing. That has to be remedied first. Okay, so that's why it's not a commitment to lend. It's not us wanting to pull the rug out from underneath you. Okay, what type of documentation you might need? Now, this will depend based on what your circumstances are. Again, go ahead and take a snapshot of this. I'm not going to read it out to you, but basically it's your income, it's your assets, credit report we're going to run, but we might need additional information if you have some alternative trades we talked about, like your Netflix accounts or your cell phone payments. We might need your bank statements to show those payments coming out, right? So there might be other information that we need there. Your income docs. Do you need tax returns? Generally, for a lot of programs, only if you are self-employed or you have some kind of specialty type of income, but there are some programs, even if you're a regular pay stub and W-2, we might need your tax returns. Talk to your loan officer. They'll point you in the right direction. What types of programs are out there? Again, I don't want to sit here and read this to you. It'll bore you to death, and my voice is starting to go. So your regular fixed rate, we can do adjustable rate mortgages. Those are coming back into style. They used to be big, then they kind of went away. Now they're coming back. Not every program can be combined with every type of mortgage loan. So if we're doing one of those 97% financing loans or 100% financing loans, we're probably not going to be able to do an adjustable. Okay, it just doesn't fit. So, but again, we'll talk to you about that. Construction, renovation, we didn't talk about that. You want to buy a piece of land and build on it? We do construction loans. We do plenty of them. You find a house that you love the location, but there's a bit about the house that you don't love. Maybe that the kitchen is still from the 70s and you're not in love with that. Maybe we can do it as a renovation loan where we're going to give you money to buy the house and money to fix it up. Okay, that's an option. That's something we have a couple different programs for, and we can do that. Conforming mortgages just opens the door. Most of what we talked about today is for conforming mortgages. That's basically up to, for a single family house, basically up to $830,000. Anything over that generally would be a jumbo mortgage. There's different restrictions on those. That's where more of your credit score restrictions are going to come into play, where your larger down payments are going to come into play. All right. We have government insured loans. We have federally government insured loans. We have state government insured loans. These would be things like your FHA loans, VA loans. If we have any veterans on board with us here tonight, we thank you for your service. We participate in a couple different veterans programs. So there's things like that. Land mortgage. There's a piece of land. You want to buy a piece of land, but you're not quite ready to build. Maybe you want to buy the land now and build in a year or two. We can do land loans. Again, a lot of what we talked about tonight aren't going to apply to your land loans, but we do them here. All right. Just some key people you're going to deal with. Obviously, you got myself front and center here tonight, but otherwise, generally, your first contact is generally your loan officer, loan consultant, mortgage specialist like Sean. Once he does the initial workups with you, then it goes to your loan processor. They do a bunch of work on it and do some verifications with it. Then it goes to the underwriter. They're the ones that approve the loan. And then ultimately it gets passed off to a closing coordinator. There's the ones, they have the fun job of getting you and the seller and your attorney and the seller's attorney all together in the same room at the same time to sign all the documents. We actually don't have to all be together anymore. It can be done separate, but it's kind of anticlimactic. I still like that thought of everybody sitting around the table, signing the documents, sliding those keys across the table to you. Here's some basic do's and don'ts. Again, you may want to take a snapshot of this. Just talking about as far as documentation goes, just save it. Again, I'm old school. I've been doing this for 33 years. I know most people, your bank statements and your pay stubs and all that stuff, you can get them online. Great. Don't sit there printing out 100 different pages. If you can get them online, that's fine. You can email them to us. Don't worry about that. Make sure you keep paying all your debts right up until closing. You never know. We may need to rerun your credit at some point. If your credit was good and now it's not so good, that could jeopardize whether we can do the deal or not, or it could wind up costing you some extra money. So we don't want to do that. We talked about like cash deposits. Don't do that. Make sure that you're spreading those out and getting them in as early as possible. Don't co-sign a loan for somebody else. If you are co-signed for a loan, the most important part of that statement is signed. People think being a co-signer means that you're not responsible for it. No, you are responsible for it. That's why people need you to be a co-signer. It makes you just as responsible as the original signer. So you better make sure you're in a good enough position yourself where you're not going to have an issue if you co-sign for somebody. And then again, if you have any type of financial moves that you're making, moving from one bank to another, withdrawing money from a retirement account, changing jobs, just check in with us and just let us know what you're doing. And then this way we can point you in the right direction to make sure that you're getting the right documentation and all that. Steps to buying a home. We talked about a lot of this already, but basically start by getting you some information together and get pre-qualified for us. Then we'll hook you up with either you have one or we can help assist you in getting together with a real estate agent. You can do it on your own, but most people prefer to work with an agent, put them to work for you, find the house, go through the process, get the appraisal done, all that fun stuff that we've talked about. Go to the closing. You're going to sign a stack of papers about that thick. You better warm your fingers up before you do it because they're going to cramp up on you. And then the keys get slid across or the code to the front door gets given to you so you can move into your new home and start the next exciting chapter of your life. And with that, call an end. We are right at 7:30. Awesome. We're calling an end to our presentation here tonight. I'm sure many of you, if not all of you, are very interested in your $750 closing cost credit. This is how you're going to get it. Okay, you're going to send an email. You're going to put the code vacation. Summer vacation's coming up. For those of you on board that are teachers, you have kids in school, I guess one of you is really looking forward to that time. Others of you may not be looking to that time, but we're time for summer vacation. So email the code vacation to dreamshappen@ulstersavings.com. Vacation to ulstersavings.com. You can put it in the subject line. You can put it in the body of the email. That's fine. You can also put in, you have any additional questions that we didn't get to. As soon as we get off this, everybody thinks of some questions or they were too shy to ask using the chat room. Go ahead and put your questions in that and we'll get back to you on those. But go ahead and send that vacation code to dreamshappen@ulstersavings.com. The other thing I ask you to do is go ahead and give us some feedback on what you thought of the presentation tonight. We put a lot of time and effort into these things, but it only works if it's working for you. So if there's topics that you wanted us to go over and we didn't, you had some topics that I was beating a dead horse on, you didn't think was necessary, be honest, be gentle. I do have kind of a fragile ego here. Don't make me cry, but go ahead and just let us know what you thought of it. And we do use that feedback to provide us for future presentations that we do. Now, please pay attention. Every time we do this, the next day I get people asking, hey, I haven't gotten my certificate yet. I haven't gotten my certificate yet. Okay, that is a manual process for us to get those certificates out to you. So give us a few days. It's Tuesday. Give us until next Tuesday to get the certificate out to you. All right. It'll probably be earlier than that, but it is a manual process that we go through and we enter your information in and give us a little bit. So check your spam folder also, because it is coming from our marketing department. So it may go into your spam folder. I just asked you to do that. If you haven't heard from us by next Monday or Tuesday, go ahead, email that same email address. I'm the one that monitors it. Go ahead and email that same email address, and we'll make sure we get that certificate out to you. If you're already working with one of the loan officers here at Ulster Savings Bank, go ahead and put that in the email as well. We don't want to cross up signals here and have you talking to two different people. So go ahead and put that in the email as well. If you're not working with anybody, you can let me know that. And with that, I'll turn it back over to Sean. See if I have a few more statements I could probably make before my voice gives out on me altogether here. But I do want to thank everybody for joining us tonight. We know everybody's time is valuable. We thank you for spending some time here. Hope you learned something. Hope you got something out of it. I hope you like my corny little jokes. And we hope to see you on the way to the closing table to buy your dream home and get into the next exciting chapter of your life.
You're getting
Sean,
some thank
any
yous and
leftover questions?
There were two questions which I answered in line because I didn't know how much time we were going to have. One question was about how do you prove eligibility for a VA loan? And I mentioned that it's usually a form called DD 214 that's issued to somebody when they leave government service. If somebody's an active service member, there's a different form that we can get for them and use that. And then the other question, somebody was asking, what is the minimum down payment for a land loan? I mentioned Ulster Savings has a 35% minimum down payment for land lending. But we do have other programs. If you're planning to do the construction loan at or around the same time, we can look at that.
Yeah, yeah. On the VA, I would just add that generally much easier for the service member to get that information than for us. Just by going to the VA website, you should be able to print out your eligibility form. It's called a COE, Certificate of Eligibility. The form number, again, like Sean said, is DD 214. But you should be able to get that relatively easily, and we're happy to work with you on that.
You've got 14 thank yous and a couple of thumbs up and claps that went by.
Okay.
I think that's it. Yeah.
Great. Really appreciate your time, folks. Don't forget to shoot us that email. You can do it right now. You can do it tomorrow. That's fine. And then, like I said, look out in a couple of days. We'll get those certificates out to you. Thank you for your time, and we look forward to making your dreams come true. Have a great rest of your evening and enjoy your summer.